And good evening. This is the Elliott wave update for the S&P 500 and the NASDAQ 100 for Thursday, December 1st, 2022. There's not much that I really can be adding right now. Let's go over the pictures. Let's go over what we might be expecting for tomorrow. And let me just repeat what now Fed Bar was now saying, slowing pace of interest rate hikes makes sense. Well, that ought to perk things up and everybody starts really buying into that, which they may do again. So I want to go over again what we did today. So starting here with the S&P, as I left it off, the market had a great day yesterday, and it appeared that I switched some of the labeling around to mark this as the X. We had an A and a B, and here's the second C wave. And the big challenge is now we actually can see here on the hourly chart 1, 2, 3, 4, 5. And right off that high, the market declined sharply and then spent the balance of the day kind of just fooling around, doing a little up, a little down, a little up, a little down. So it doesn't leave us, or it doesn't leave me, with a very solid view that this completed that C wave, because it is 5 up. But I have to allow for some additional time and for what the market could choose, that it is going to continue to go up. And again, it puts us into a spot, and I will just switch over and throw up the extensions for the C wave. So right now we got up to 1.236%, where wave C would be equal to 1.236% of wave A. Obviously, we still have resistance at 41.30. We have 618 resistance at 41.62. 41.75, I'm going to call it. So those all still remain in the picture. In fact, who are we to say that the market can't go up to 4,200? Or who am I? And I'm certainly not anybody that can say that with defined purpose that no way, no way. So we have to leave things open and allow the market to tell us. I have some ideas now that we now have gotten to here, and to just add them to this conversation. If this indeed completed that wave C, and we are now going to head lower, because I can possibly put a wave 2, an intermediate wave 2 above it, then the expectation would be that an intermediate third wave is going to begin. How that started, it would not have stopped and found its way all the way back. And I'll show you what I mean by that. I'm going to flip over to the line chart and look. It's all gone. That tail, as if it didn't exist. So what we get is a 1, 2, 3, 4, 1 of 5, 2 of 5. Even with that coming down as far as it did, when we look at it on a closed basis, it's still in process. So taking it back to here can give us a little bit of like, what? See how the difference is? In fact, all of these tails didn't happen. So we get a very small response to that drop. In fact, it doesn't even consider the whole drop. It takes it back up to here. So, and these almost like they didn't happen. So it just presents a very different near-term, very short-term picture on the hourly chart, leaving a lot of room for this to possibly be wave 1 of C, wave 2 of C, and then another rally for wave 3, and then a 4 and a 5. And then we're just continuing up there. If we do another 5 up, and that's just wave 3, then a 4, and then we're doing a 5, we could end up at 4,300. So definitively can't say either way. You can see the narrative starting to build and people wanting to change the narrative. Taking the focus off of inflation, taking the focus off of interest rates, taking the focus off of everything and put it back on we're bullish, we're bullish, we're bullish. Now, if they're watching anything, for example, here in the bond market, look at these climbs. But remember, as I've talked many times, and I'll say it again today, the bond market continues to go through what is best viewed as a relief rally after a very strong 3-month decline. And right now, the 30-year bond got up to the 0.382, 38% retracement of that decline, held it, sunk a little bit today, but now is ending the day at the weekly 20 moving average. But still, it's finishing up here on its high. What's next here? 131.25. That would be the next level. And that's just a 50% of this decline. I'm not going any higher. So even if I got 1, 2, 3, 4, 1, 2, 3, 4, 5 of 3, 4, 5, we likely could get a much larger rally. Relief rally. But when we have to then balance it out against reality, and that we're certainly not looking for interest rates to come down. I'm not looking for a total pivot and a turn and, a reduction and not a raise, but a lowering of interest rates. That just does not make sense. Against what Powell's been talking, against what this guy has been, all these Fed governors out there this week have been talking about, that they have to remain consistent, that they have to remain strong. And it's true, they do. But we still are going to see bounces, relief rallies, so to speak. That's just a natural part of the ebb and flow in the market. So how high is that going to get? Well, now we've gotten up to here, which is some resistance. Fib resistance comes up here at 131. And this we saw was kind of some panic selling that brought it down to there. So seeing it come back up is not totally unusual. Over in the 10-year note, it's going to be the same story. The 10-year note, I felt, could get to here. But even today, you're seeing it. It just went right on through, got above the 20, and will be heading up here to this next resistance zone, which is 115 to 115.14. And that's going to represent about 3.5% rate on the 10-year note. Now, could that be a reality? Yes. But I got to tell you, there's a lot that would have to be adjusted if it gets there. So that's the other thing that I want to say. It's not as if the marketplace is changing its mind, that is totally now just going to pile back in. I think some of it we're seeing, they're piling back in. I think that some of it is you've got a lot of people that are willing to now move into interest rates and pay for them, right? Instead of getting it at a lower level and paying now, and then when rates go up again, they'll come tumbling back down, and then we'll see a mass exit of everybody getting back out of the bonds. In any case, these are things that when you factor them together, give an upward boost to equity, an upward boost to people who maybe need to get long or need to make adjustments on positions. The other thing that's coming up, folks, is tomorrow is, once again, expiration. So we have options expiring on all the indexes, options expiring on all the underlying component stocks of these indexes, options expiring on volatility, options expiring on the bond and the treasuries, everything. And that will have an effect on where prices get pushed to. I'll tell you right now from my observations, I would think that Apple's going to make a shot at 150 to 152.50. I think as it's being left right now, I think that Microsoft is going to have a shot for 255 to 260. I think that Amazon will be maybe gunning for right around here, 95 to up to 100. I think that AMD is going to take a shot for getting a little bit higher than where it is, but it's somewhere between 75 and 80. These are all stocks that did magnificent yesterday. They got pushed and pushed and pushed. So I don't know, but I think that we have to leave additional room in the S&P and in the NASDAQ, but I'll get to that in a minute, for additional upside. I can count as complete 5 waves up off of this low. I cannot put the C and everything else on top of this. Can't do that yet. So I'm leaving that open. If the market is, and also tomorrow we have the employment situation. Let me see if we got anything else besides that. Right now, what we got is the employment situation. Pretty much that's it. They got Thomas Barkin speaking tomorrow, Charles Evans speaking tomorrow. In fact, Charles Evans got 2 speaking engagements tomorrow. And those are Fed governors, and you will see what they say. Again, the employment situation is just going to give us more into what's actually happening in terms of more people getting jobs versus more people going on unemployment. But that's going to be for the month of November. So we'll see how that's going to be interpreted, how the market will take a look at it. They weren't too bothered by the jobless claims today. Initially, they thought they'd run it lower, and then somebody thought, nap, and they decided that all bad news is good news. And I don't want to be misunderstood here, so I'm going to repeat again. The fact that many people are finding jobs is actually a good thing to me. I'd rather that people were working than not working and having to really scramble to find how they're going to make their lives work and how they're going to, do what they need to do for their families. So I personally think it's a great thing. Unfortunately, it does contribute to the inflation cycle. So when the Fed governors are out there stumping, saying that what we really need to see is a higher unemployment rate, it almost seems wrong to say that, but it is true. It is true. It's money coming out of the system instead of forcing things up. So I'm glad that Americans are finding jobs and getting back to work and earning money. I am pleased that the infrastructure package passed, that it releases a great deal of money and that'll start to be doled out next year and putting even more people back to work. And they're going to be good paying jobs. They're going to be, I think, a lot of blue collar jobs because it's a lot of construction. It's a lot of repairing our infrastructure, which, by the way, I think we can all agree is desperately needed in many, many, many areas of the country. So that, again, will be inflationary. How we want to interpret that or how the market wants to interpret that, we have to wait and see. But again, what truly happens now, one of my major observations is that we are not fundamentally based anymore. We are algorithmically, quantitatively based trading. That's it. So it's technical. And it's what the charts are telling us and what these moves are telling us and how this is interpreted, et cetera, et cetera. It's also that there is a great deal of money still available in the markets, swirling around in the markets each and every day. And that also keeps it all going. The firms that are trading, that are taking money in the hedge funds and the mutual funds and the different firms that are large trading firms, they have very large positions on. And a lot of those positions are in options, and a lot of those positions run on an expiration cycle. And as we get close to those expirations, we see a lot of crazy moves. because people are, and firms and positions are forced to adjust or, get trashed. So if the factors that create the scenarios that we see and what we attempt to trade don't always reflect what really is happening within our underlying economy, within the country, within the globe. So I try to present both sides. I try to do it as fairly as I can see it, but also according to Elliott, according to what Fibonacci allows us to see. It is not a perfect science, but it is pretty steady. And it is, I have found over my years, a very good methodology to track a market's progress in any cycle. I continue to believe that we are in a bear cycle. We are in a down trend. The trend is down. We're correcting at least 13 years of rally. We are correcting at least from 2009 to 2022. That part I can tell you. That much I'm certain about. And I don't believe that correction is over. I don't think that correction will be over until we start honing in on the March 2020 lows. Then first leg of this correction is likely to be complete. So therefore, it will be a much longer term correction. We need to adjust and realize the excess that exists, and it will be dealt with. It is the way it is, and we need to trade and act and trade accordingly. As it goes. So with the S&P, yes, I could say it's all done. If that's the case, the market should not be hanging around where it's hanging around. It needs to go and it needs to come down. And it may start and do that tomorrow. We have seen where we'll get an economic figure first thing pre-market, and that sets the tone, and boom, they start taking it out. They start killing it all. I will say that from today, we saw initially that they came in and they whacked Apple. We saw initially that they came in and they whacked Microsoft. Both were down big early this morning, recovered and started to come up as people prepare for tomorrow. So we'll see how this all pans out. We've also seen where after a large move up and we move into an expiration, they reverse everything and it goes totally against what you felt that they were going to do. These things all just remain out in the open, and I don't have a crystal ball that's going to tell me what's going on. But if that 4110 marked the high and completed that C wave and that intermediate wave too, that was a good start. The drop was a good start. We saw that how it actually on a line chart actually looked like nothing. But I would be expecting tomorrow there'll be none of this. It's just boom, and then boom, and then boom. And we just start to tackle, and all of this likely would be taken back. And we'll end up back down here. That would not surprise me. Over in the NASDAQ, let me finish with the S&P. However, an upside move would likely push through much of this resistance, and this market would end up closer to 42 than 41. That would be my thought process. Over in the NASDAQ, it's the same story. Notice how I'm leaving this blank. I have to. We do have a 1, 2, 3, 4, 5. Nice start, but it's going to look, let me show you. It's going to look exactly like the other. Wow. Not even. Looks worse, right? Still 1, 2, 3, 4, 5, but what's that? Look at the little nothing. Let me take it back so we can see what the candles look like. Wow. A whole lot different. So again, just as within our other markets, yeah, Yes, I can run from here. I'm just going to look for that, the balance of this C wave. Oops. We can see that we've gotten up to 1.618, where wave C is 1.618 times the length of wave A. Pretty good. And actually pretty strong to have completed it. But I can't say that it is. We continue to have resistance at 12,157, 12,275, and 12,431. Again, 12,500 remains, and you're going to see that that channel line, that's something I forgot to mention, and the other goes from the all-time high, connects the August high, and it smacks today's. And I go back down to the hourly chart, go up, it sits right at 12,520. So those numbers still remain. That 12,500 still remains in the picture. And maybe we get that 500-point rally, and then this truly can be all done. We have to wait and see. But I remain in the position of saying, if this is the completion point, it hit the resistance, it got rejected, and now it tried to get itself back up there, and they're selling it a little bit now as we close the session. The after hour is now done. So it's a difficult market. It's sometimes difficult even to trade, not impossible, but it isn't the easiest in the world. And again, most of the good trade is within the first hour and a half, maybe 2 hours, and you get a little bit later. But in between, it's a lot of pushing and shoving. So that's another factor. It's just a lot of posturing, positioning, adjusting, a lot of stuff going on. And whether I feel comfortable with it or not is not relevant. What's more relevant is like there is something very, very much happening underneath this. And that's the part that kind of concerns me, because I actually don't feel that it's good. I don't feel that this upside needs to, grab onto some traction and go. I think it would be a bad thing, to be honest with you. I think it would lure in way too many people and then just absolutely smash them to smithereens in a couple of weeks. But maybe that's the plan. I don't know. Right now, I think we need to allow for continued upside. And I just gave you the resistance zones on the way up. Ultimately, I still hold out at 12,500 is where this market likely will end up. But I will take my signals as the market gives them. We did reach a resistance today. It was rejected, and we've not gone back above it. We may again do it tomorrow. If that happens, look for 12,156 and above. If it doesn't and it starts to collapse, it needs to do it without pause. That's what I refer to, that it will sell with purpose. This was buying with purpose. Whoever was doing it needed to adjust positions, many positions, and that forced others to adjust, and that et cetera, it's like a dominoes. But there was purpose. That's why it didn't stop. That's why on an hourly chart, we barely even saw a pullback until it got all the way up, and then it didn't really pull back all that much. Okay, I am going to leave it there. Again, tomorrow, expiration across the board. Employment situation numbers pre-market. Have a great trading day tomorrow. Expect the unexpected and trade well. Our next update, I will be making this podcast that I've promised all week. I will do it on Saturday. So I'll post on Saturday and then likely again after the markets open on Sunday to just give a quick update on what's happening there. So podcast will come on Saturday, the 3rd. The next Elliott Wave update will be on Sunday, December 4th. Have a great weekend.